Good morning and welcome to the OTC Markets Group Thought Leadership webinar series. Today we'll be discussing how to manage increased SEC costs and having listing alternatives, and also talking about non-compliance notices from national exchanges. Just a few housekeeping items before we get started. If you do have any questions, you can type them into your chat box and we'll have time for Q&A at the end of this webinar. But I think we'll just dive right in. We have the privilege of having several distinguished guests who will be discussing listing choices, delisting off national exchanges, non-compliance notices. We'll talk about process, how to raise capital on OTC, and solutions for micro-cap companies. Joining us today is Walter Van Doorn, partner at Dentons. Walter advises issuers and underwriters and financial institutions on securities and capital markets transactions, including IPOs, public and private offerings, equity and debt, both domestically and internationally. Earlier in Walter's career, he was counsel at the Office of International Corporate Finance at the SEC, and he brings 30 years of experience, not to make you sound too old, Walter, of SEC experience for both domestic and cross-border offerings. Glad you can join us. And Rob Wozak, who is currently the president and CEO of Freedom Capital. Prior to coming to Freedom, Rob was a founding member of the Wozak Group capital markets advisory firm, specializing in small cap public issuers and IPOs. Prior to that, Rob spent 10 years in senior positions at the New York Stock Exchange and the American Stock Exchange, working on over 600 transactions and 200 listings across markets and uplists in SPACs and IPOs. And lastly, we've got Joe Oltmans, a senior vice president in corporate services here at OTC Markets. Joe brings 10 years of experience from the Amex. He's been with OTC Markets. He's head of domestic U.S. new business for the past 14 years. I want to welcome everybody to the webinar, and I'm Andy Kizik, a Senior Vice President in Advisor Relations, and I will be the moderator of today's event. A lot of questions I get around this, are you getting the value as a micro-cap company on your exchange listing? With the ever-increasing costs of advisors and exchanges, is it really getting you the return of equity, return on investment that you actually provided? But we have choices. We've studied the fact that delistings can save companies around 70% in fees by listing on our market of OTCQX or OTCQB or premium markets. So there are choices. And part of today's webinar will be to discuss those choices, discuss delisting from an exchange, discuss the process of non-compliance notices. But before we dive in, maybe the best way to start is I want to start with Walter. And Walter, there seems to be a bit of confusion around the term exchange delisting and SEC deregistration and non-compliance notices from U.S. exchanges. Can you walk us through those differences so everybody has a good understanding? Let's flip to the next slide.
Sure, Andy, thank you. And I can do that. And just before I start, I want to thank you and OTC for having me and thanking everybody for coming. It's a pleasure to be able to speak to all of you. But Andy, to get back to answering your question, it's a very good question. It is one of the biggest misconceptions from a legal standpoint I see clients and others having to deal with here. And there are these two words you see on the slide, delisting and deregistration, and they do mean two different things from a legal standpoint. As the slide tells you, delisting is a process for getting off the stock exchange, whether it be New York or NASDAQ or whatnot. Deregistration is a different story. That's terminating your legal obligation to the U.S. government, to the SEC. Maybe restating the obvious, but the stock exchanges, New York Stock Exchange, NASDAQ, or even OTC for that matter, are private organizations. They're not part of the government. The SEC is the U.S. government agency that regulates public and listed companies. So terminating the obligations for these two aspects are different matters altogether. It does merit taking a few minutes to talk about that. So maybe, and if you put up the next slide, yeah, we'll move into delisting to start off with. So as I said, delisting refers to the process of terminating your listing on a stock exchange, which again is a contractual arrangement, is a general matter between the company and the stock exchange. The typical way of doing this is not too difficult as these things go. As the slide says, it mainly requires filing a fairly simple form with the SEC, Form 25, and issuing a press release, notifying the stock exchange and the public that you're going to be terminating your listing. And this, by the way, is the same process for American companies and for non-American, for foreign companies. And we will talk a bit here about the difference between US and non-US companies. In some cases, although not with delisting, there is a relatively significant difference for the two types of companies. But in any event, delisting is the relatively easier of the two processes, mainly filing a so-called Form 25, and then you end your process with the stock exchange. Give me the next slide, Andy. So the deregistration, a little more complicated. As I said, deregistration is more of a legal concept. It's terminating your relationship, your obligations with the SEC, with the US government. The first thing to know about deregistration, it's not completely voluntary, unlike the delistings on the stock exchanges, which, assuming you can check a few boxes and jump through a couple of hoops, are pretty much voluntary. You can't just necessarily deregister or end your government obligations just because you want to. There are standards here, as you can see on the slide, and mainly you have to have a limited number of shareholders, stockholders, and potentially a limited number of assets. But assuming you have more than 10 million of assets, the primary test is, do you have fewer than 300 record stockholders? Now, important legal point here is it is stockholders of record. So that does not mean human beings, people on two legs, right? It's registered or nominal shareholders, which could be big investment banks, brokers, and whatnot. So that does make the process a little bit easier than having to look all the way that far down. But assuming you meet the standard of having less than 300 registered shareholders, there's a different SEC form you file, Form 15, which gets this process moving. Once again, the form itself is not all that difficult. What can be more difficult is meeting the test of having less than 300 shareholders. As another anomaly here, it's just an odd aspect of the law. The obligation to the SEC is only quote unquote suspended, as you see on the slide, which means in theory, if you have less than 300 registered holders, you're eligible to deregister. You file your Form 15, that's all good. If some point in the future, you have more than 300, you might be once again obligated to begin or resume, I should say, resume your reporting to the SEC. So you do have to be mindful of that. Now, for foreign companies, there's another approach which can be more beneficial. And this is only available to foreign companies who meet the SEC definition of a foreign private issuer, which basically means you're incorporated overseas and you have your majority of your shareholders overseas. If you satisfy this SEC rule 12H6, you can deregister, and you can deregister from the SEC permanently by filing a Form 15F, a little bit different from the Form 15, but still relatively simple. But as you can see, it does have a number of requirements. You have to have been subject to SEC reporting obligations for the past year. You have to be in good standing and current with all your SEC filings for that past year. With a few very minor exceptions, you can't have carried out any public securities offering in the past year. And quite importantly, you have to have had your primary trading market on a stock exchange overseas. But if you meet all these standards, you don't have to worry about necessarily worry about the 300 stockholder test that we previously discussed, and you can file a Form 15F and deregister from the SEC permanently.
Walter, around these rules and requirements, how long does the process take? You mentioned that the exchange notification is 10 days from the filing. How long does it typically take for the delisting and simultaneous deregistration if everything is in order and you meet the less than 300 shareholders as a domestic US?
Yeah, if you meet all the tests, the various standards we've been talking about in the last couple of slides, the SEC forms, whether it's a Form 15, a Form 25, or Form 15F, as these things go in the business, are actually relatively simple forms. They're just a couple of pages, mostly checkbox type forms. So whatever law firm you have doing this should be able to put those together pretty fast. There are these notice requirements for the 10 days we talked about. But other than that, there's not much else you need to do. You just simply file them. Now, The SEC does have, I believe from memory, 90 days to object to the filing. In my experience, that rarely ever happens. But as soon as you file the forms, you are, assuming you're qualified to file the forms, you are delisted or deregistered, as the case may be, and subject to any objections from the SEC, you're good to go. You're deregistered or delisted. So it's actually a relatively easy process, assuming you're qualified.
So these are for voluntary delistings, Walter. So I choose not to be a registrant anymore. I choose to come off the exchange. Can you just touch upon, some companies don't meet the market cap or equity test. Can you just explain quickly what a non-compliance notice is from a U.S. national exchange and how that process works with the corporate issuer?
Yes, that is another way, unfortunately, an involuntary way of getting off the stock exchanges. Is if you don't meet one of their substantive standards, which Andy alluded to. I don't know them all by heart, but there's a standard for trading volume, number of shareholders, stock price, things of that nature. If you don't meet one or more of these tests for some period of time, you will get a notice from the stock exchange itself to the company, telling the company they don't meet these standards and they haven't met them for a period of time. And each stock exchange has a few different sort of bells and whistles, but generally speaking, you have sort of a probationary period. You have an opportunity to cure whatever is the violation you may have met. And this can be somewhat subjective in my experience and negotiated with the stock exchanges. But generally speaking, you will get one of these notices. And if within a certain time you don't rectify whatever the problem was, whether it's the trading price, number of shareholders, trading volume, something like that, the stock exchange will file the notice for you and you will be delisted that way.
Walter, I wanted to go back to the magic number of 300 for 1 second. I know you mentioned it's a record number holder. But what if I was above and say slightly above? Say it was around 300 and say 50 shareholders. Is there a way, or are there ways to kind of get below to that 300 threshold? Like, for example, reverse splits, or say a share buyback, for example. Are you familiar with those two avenues as companies look to maybe get below the 300 threshold?
Yes, that is correct. There are some different corporate, techniques you can use to reduce your number of shareholders. You could do, issuer buybacks. You can do, as you say, reverse stock splits, things of that nature. Whatever you can do to get the number down works. It's a really very much a black and white test if you have, below 300 registered holders or you don't. So whatever method might be effective is generally considered acceptable.
Is there a time frame to do that in concert with, let's say, a reverse split or anything like that? Or is it in conjunction with the negotiation of the exchange?
Yeah, no, you can do it right away or in conjunction. So again, remember the number of shareholders gets to the SEC deregistration, which is different from the stock exchange process. The stock exchange process can be voluntary, or as we said, it can be involuntary if you violate some of their standards. But the requirement to end your SEC, which is your governmental reporting obligation, is the one that targets the 300 registered shareholders. And pretty much you can use any method you're able to use to get down below that number.
That's great. Now that we've kind of laid some groundwork on choices, I want to shift a little bit and look at the after process here. So if let's say I'm a CEO or CFO of a company that's listed on a national exchange, and I just announced my intent to deregister with commission and delist, what are my options for liquidity if I choose to move to the OTC? What are some of the disclosure requirements I might have? What happens with the company? Joe or Rob, you want to jump in?
Sure, I'll start, Andy. So there's a path, and there's been a path, for a number of years for companies that go through this process. It did start with international companies over 10 years ago, but since then it's taken up some more steam with U.S. companies. Our market, we operate very much like NASDAQ or NYSE. We trade 12,000 companies on our market. We divide our market into 3 different tiers or markets. There's OTCQX at the top. In the middle, there's OTCQB. In the bottom or default market is our pink market. But for the most part, and looking at coming off an exchange, most companies will look to QX or QB. But I do want to go back, to the term deregistration just for a second. Many people, I think, sometimes pull that with, say, going dark or going private with deregistration. And that's not the case in all cases, especially when it comes to our market. as companies, deregister from the SEC and come off of an exchange, they have an option, and here's where the path comes in. They have an option to keep their symbol, maintain their disclosure, and have liquidity for their shareholders. It's usually done through our QX or QB markets. One question we get is, in coming off the exchange and in deregistration with the SEC, A is how much money are we saving? That's one question we kind of get typically. But B, the main question is, what disclosure requirements do we have to do going forward? And both QB and QX, those two markets, both have disclosure requirements in place. It's called our alternative reporting standard for disclosure. And just in summary, if a company were to say, opt to say report through OTC markets using our reporting standard, you still have to go through an audit to qualify for OTCQX or OTCQB, and it must be a PCAOB audit. You do have to do your quarterly statements as well. So there is ongoing disclosure there for your shareholders. But with that, you save a lot of money at the same time when you do deregister. For example, your quarterly reports do not have to be reviewed by your auditors. That will save you a lot of money, but yet still maintain that disclosure for OTCQB or OTCQX. Your Sarbanes requirements go away. You save a lot of money there as well. Your EGR fees, kind of also go away. We work with a lot of community banks that have gone through this process and other domestic companies. I think they'd probably say, and still maintaining their disclosure on OTCQX or OTCQB going forward, they're saving roughly $500,000 per year. And by going through this process. And like I said, the main question we get is on disclosure for this path. It does require a bit of work, going forward. But from my experience here, for companies that have had disclosure in place and doing their SEC prior to deregistration, they're pretty equipped with, abiding by our requirements on OTCQX and QB. It's a rather easy transition for them, has been my experience here, Andy.
So Joe, if a company says we're going to go forward with delisting and deregistering, in terms of the process, they can contact OTC, can contact you and say, I need to initiate an application to make the seamless transition. What happens at that point of transition when they close down the exchange listing and it comes to OTC? Does the ticker remain the same? The broker's notified? Maybe you can talk about the seamless transition for a moment.
Sure. One common question we'll get, is when we move to OTC, is there a lag in trading between coming off NASDAQ or NYSE and OTC? And the answer is no. You trade the next day. It's very seamless. By background, we trade 4-character symbols here. So typically for a NASDAQ security, which has 4 characters, the symbol remains the same. If you're on New York and have 3 or 2 or 1 characters, it would change to 4. But again, the main, I think, issue or concern companies have is there a lag in trading? And the answer is no.
Right. Andy, maybe I'll just jump in here quickly.
I was just going to say, now let's talk a little bit about the banking side and the capital market side, because
Sure.
How do you raise money? How do you continue that process? Go ahead, Rob.
Sure. Well, first of all, I echo Walter's sentiment. I would thank you and Joe for inviting Freedom Capital Markets and myself to participate in this webinar today. I think it's a very timely topic and something that's frankly quite relevant at this point. So, look, I think to echo Joe and Walter's comments here, I think when we're looking at when this is happening and a company's facing this decision, right, where they have to, make a move, I think the first and really most important thing to think about here for issuers is this is not a death sentence, right? It's not something that it's the end. There's really a way for, within the platforms of OTC, QB, and QX, where there's a certain governance requirements and disclosure requirements. And as Joe pointed out, the liquidity and the volumes are still there. It gives the company, a lifeline and allows them to remedy the issues that maybe got them in a position where they were going to deregister or get moved off of an exchange. So, and Andy, from a capital raising standpoint, when you're looking at these types of companies, it also is not a death sentence. There really are options for companies that are in this position that find themselves onto the OTCQX or QB. And we've been in this world a long time. Joe, myself have frankly been involved with listing micro cap companies or intertwined with them for the better part of the last 20 years. And I think the formula here is pretty simple. Whether you're a company in good standing or a company that's in this position, it's largely about the investors that you try to attract into the company and that you attract into a potential capital raise and or deal. And if you separate yourself away from, let's say, some of the structured funds that might be out there, or the predatory type of investors that look to take advantage of companies that may be in somewhat of disarray or disrepair, there are really other options out there. And we've talked about this a few times. I mean, within even our practice here at Freedom Capital Markets, we have a pretty robust, let's say, family office practice. We have a very distinguished and differentiated retail base. So, tapping into these different types of pools of capital potentially for these companies that are in this position, I think give them a chance to right the ship and put them back in a much more favorable light within their cap structure and within their eventual capital markets evolution and growth moving forward. So pause there.
So that's very encouraging for a micro cap, because one of the questions I get a lot is, how am I going to raise money? So you seem to answer that you have a diversified investor base. You can raise small amounts of capital, whether it would have to be if they're registered publicly or whether through private placement. And
Absolutely.
Pricing, trading, settling, and clearing those trades shouldn't be an issue, correct?
Absolutely. I mean, there's a few different ways to look at this, right? I mean, a company that's still in good standing, is a SEC, obviously could file a registration statement, right? You got potentially do a private placement here. There are potential bridge financing options available here as well. And at the end of the day, if you're able to accomplish that, and with respect to the clearing piece, I think that's an important aspect here, Andy, as well, which you just brought up. If you're doing this through a brokered transaction where it's kind of pre-cleared through a clearing firm that understands the rules of engagement and that will give the potential investors or shareholders a platform to trade and clear and settle this stock. And that's kind of we've done a few transactions that we've done. I think for some of these micro cap companies that don't do some of these brokered transactions, or maybe get wrapped into the wrong subset of advisors, they get led down an unfortunate, incorrect, mousetrap here. And I think if you do those pieces the right way and allow the natural liquidity to come into the stock through a bona fide clearing agent, I think that helps facilitate the liquidity, the transaction, and the potential remedy and or success of the company moving forward.
That's very encouraging. And I'm glad you spent a minute or two talking about that, because we have a lot of companies that try to come into an unbrokered private placement and they end up getting stuck with shares. So that was a very good point, having an advisor work with you on a pre-approved basis. I'm going to jump back a little bit in terms of, and I'll open this up to anybody in the panel, who's a suitable candidate to delist? And I also want to talk a little bit about more common non-compliance issues that exchanges, that exchange listed companies face. I'll start with Walter or with Joe. You want to jump in?
Sure, Andy. So two things, right? What's a good candidate to deregister, and also which is a good candidate to delist? I'll start with deregistration first. Typically, companies that benefit from deregistration, well, there are two groups, I would say. One is community banks. And the reason being is that most community banks are already highly regulated. They're usually tightly held, and they really don't get much value on being on an exchange. That segment alone is a great, I think, group to deregister and join, whether our QX or QB markets. The second would be, if you're not in a community bank and you're trading on the exchange and you have a float of, say, between 10 and 20%, and you say maybe trade less than 50,000 shares per day. At that point, you really have to kind of ask your board, what value you're getting really out of an exchange. If you're not raising money and your float is small and you're tightly held, it's really a good way to deregister and save a ton of money and kind of return those savings to the company or to your shareholders. That's deregistration. For delisting, I would say, what's very common now, as we've all are aware of, is there are a lot of companies on the exchange below $1. And they're kind of faced with the decision, do I reverse split to stay on? Or do I, move to OTC markets and join OTCQX or OTCQB? I would like to get, Rob's thoughts on this and also Walter's thoughts on this too. But in my opinion, I'll say that any company below $1 on the exchange, around 50 million market cap or less, would be a good, delisting candidate, a good voluntary delisting candidate for OTCQB or OTCQX. I personally see a lot of value in the exchange if you're in an index, right? Makes a lot of sense. But when you're small, and we all use a different, I think, number for microcap. Some people will use 250 million and below. I use roughly 50 million and below. That could be nano cap too. But at that nano cap, micro cap level, I don't think you're getting much institutional ownership. You're not getting much coverage, and you're not in an index. And so if you don't kind of hit those three boxes, I don't really see much of the value if you're in a non-compliant situation and trying to reverse split and maintain your listing. But that's my opinion, my view, obviously. But I'd love to hear from Walter and Rob on this.
Sure, Joe, I'll jump in. I concur with that sentiment, and I think you and I, frankly, have been in these situations, from the other side of the equation, on the listing side of the equation at a national exchange. And invariably what happens in our experience, in my experience here, is when a company that is in that position, that maybe under $1, is contemplating, and they actually go to do a reverse split, it's being unfortunately done from a position of weakness and not of strength at the end of the day. And when that typically happens, it attracts the wrong subset of people that are going to take a look at that company, potentially look to short the company, potentially look to play games with the company. And that's where I think companies have to really look in the mirror and rationalize what the benefit is of doing that reverse split, because we've all been down that mousetrap where companies have, over the course of 1-2 years, done 1-2 reverse splits. And to Andy's point earlier, they go from a reasonable number of shares outstanding to a very de minimis amount of shares outstanding, hurts the liquidity in the company tremendously, and puts them in a really disadvantageous position to have any potential capital market success moving forward, in my opinion.
Maybe I'll jump in just to add another angle to this discussion. I don't know how many listeners right now are overseas outside the United States, but a great proportion of my clients are foreign companies. And I think there's a particular benefit here for foreign companies, especially those that are listed on a qualified foreign exchange. The list of those exchanges, by the way, is on the OTCQX or the OTC Markets website, but it's most of the prominent, recognized foreign stock exchanges. So if you're a company listed on one of those stock exchanges and you have most of your trading volume overseas on that exchange, and you have a relatively small amount, typically less than 5% of your trading volume on an American stock exchange, you can really have a full sweep here. You can deregister from the SEC, you can end your obligations there, you can end your listing on the US stock exchange, and you can move over to the OTCQX market in most cases relatively easily. You can save a great deal of expenses, you can save a great deal of legal burdens, you can end most of your Sarbanes-Oxley obligations and compliance requirements that have been alluded to before, and you can still keep your trading in the US markets and keep your trading available to American investors as much as you need to. But since you're already listed and in compliance, presumably on the exchange in your home country, you can really piggyback on that and for whatever you need to do in the United States. There's an SEC exemption called Rule 12G32B. I'm not mentioning a lot of rules or numbers in this presentation, but this one is relevant if you're in this scenario. Rule 12G32B, which all you need to do to comply with it is post in English on your corporate homepage, whatever you're filing in your home country and your home country stock exchange. And assuming you do that, you'll be in compliance with any SEC requirements, and you'll also satisfy the OTCQX requirements for the OTC listing, and really save a great deal of expense and burdens, and at the same time maintain a very, very acceptable, U.S. trading market for your remaining U.S. shareholders.
Thanks, Walter. Joe, any further comments you wanted to add to that?
No, I think we pretty much covered, Andy, on the reverse between, Rob's commentary, and again, obviously, my opinion is a little biased, but that's, my opinion. But I think end of the day, Andy, companies at this stage in this environment, whether foreign or domestic, really have to, I think, look at, their costs, right? And look at ways they can maybe reduce cost, this year into next year. And yeah, there are options on OTCQX and QB here at OTC. But more importantly, they should look at, where they can cut, whether it's accounting or it's legal or administrative, fees.
Okay, so let's say I'm a CEO of a company and it's time to speak a little bit about notice of non-compliance, right? We talked a little bit about reverse splits, mentioned convertibles a little bit. I'm on my second extension with the national exchange. I'm falling below a bid price. What's your experience with companies that have been affected with a reverse split? And what should I consider? And then what's the next step? I'll put that open. Maybe Rob, you want to comment, or Joe to start?
Rob, you can go ahead.
Sure. Thanks, Joe. Yeah, look, the reverse split decision, again, in general, I think is a enormously challenging one for the issuer at the end of the day, because seemingly they think that by doing so and getting to that, let's say if it's a 3-to-1 or 5-to-1 to get them back to $3 or $4, that they're going to magically, things are going to change for them. And invariably, it almost in every instance doesn't occur that way. You see the stocks drop right back down, in our experience, in my experience, and put them in a position where they're still in the crosshairs of financial disrepair and or delisting from the exchange. And then they're forced to make another decision with a far less robust cap table, cap structure, and invariably puts the company in that position where it's not going to work out. And again, look, OTC and if you look at, frankly, our parent company, Freedom Holding Corp, FRHC, at the end of the day, is an amazing byproduct of what the great platform of OTC is, right? Our company did a reverse merger to go public back in late 2015, early 16, landed on the pink sheets. The company migrated up to the OTCQX and frankly seasoned there for a couple of years, right? It got its sea legs as a public company. It demonstrated the appropriate growth, put the appropriate, let's say, IR regime and plan into place, met investors, right? Hit milestones, showed the appropriate top line and bottom line growth, and put the infrastructure around the company. And when the company got to a certain point, it then made that move up to the national exchange. And when the reverse merger was still done, the market cap of the company on OTC was roughly $150 million. Today, as we sit here as a public company of our parent company, it's a $5 billion market cap company on NASDAQ. So again, I think, the platform that OTC has created is, a lot of times is often looked at as, oh, it's not the right platform. But at the end of the day, what you guys have done and what OTC and management has done is really provided the platform to allow companies to get their sea legs, to grow, and then potentially make the move. And when it's happening the other way, you give the chance to that company to remedy themselves, get their act in order, find maybe the appropriate capital, and then give them a fighting chance to be a viable, successful public company moving forward. So I think that's an important, thing to bring up here, Andy and Joe, because oftentimes when people are talking about this, they view it as a real net negative. And frankly, from where I sit, I actually view it as a positive because of the platform that you have built here.
Yeah, you've been through it. You've done it. In the time we have left, before we go through any questions that are popping up, I guess one of the questions I had to the panelists is, in talking to issuers, what are some of the questions and concerns a company should have when evaluating the process, and any closing comments that you might have to add to this? So we've got 7 or 8 questions that have popped up. So I want to put it out to you guys. Walter, any thoughts?
Sorry, let me unmute myself. The big question from a legal standpoint is, what are your legal obligations, your compliance duties, and I think what are the costs for those? And presumably the company will want to weigh that against the benefits they're going to have from being on one of the stock exchanges or on OTC. And as we've discussed with OTC, because it's not a listing venue that requires, full SEC compliance, especially for foreign companies, you can really dispense with a lot of your obligations and a lot of your duties. For example, again, you don't need to have most of the Sarbanes or any of the Sarbanes-Oxley compliance obligations. For example, if you're a foreign company in your home country permits it, you don't have to be a PCAOB approved auditor. You don't have to use such an auditor, I should say, for your financial statements. So there are quite a lot of benefits that you can achieve. And you can have at the same time virtually the same trading market in the United States, the same liquidity and the same trading volume, without going through a lot of the hoops you would need if you were on one of the conventional stock exchanges. So that's probably the biggest legal distinction.
Thanks, Walter. Joe, any comments? Closing comments?
I would just go back to cost, Andy. Listing on NASDAQ is very expensive, or New York for a small micro cap company or nano cap company, right? For companies that are in the non-compliance situation, the hearing fee alone to go to NASDAQ is $20,000. That's the cost of joining OTCQB here, and that's a flat fee. So as companies kind of budget, this year into next year, there are a lot of ways companies can save and still maintain their market and shareholders and access on OTC.
Yeah. Rob, anything?
Yeah, and look, I think at the end, the companies, frankly, that are in this position have to take a look at it in a very holistic way and consider all of the above variables. Cost is obviously coming into play. What are the drivers that got them into this position? And how can they potentially be remedied? Is something that I think a CEO has to really rationalize with his management team and board or her board to figure out. And what is capital needed here to kind of get you back in, or is it another issue that's getting you into this situation? So when you evaluate that all, oftentimes I think you come to the answer that maybe going and moving the company to the OTC from the national exchange, because of some of these variables and influences, is probably the right decision to make. And I think oftentimes CEOs are enamored with wanting to, say they're still a NASDAQ company or a New York Stock Exchange company. But at the end of the day, taking this route to OTC, I think in many instances probably is the most logical pathway for them to do and to take, for them to get in a position to get them back to where they would hope to be in their evolution in their cap table.
It's been great. I want to thank all of you guys for participating in this. We're going to go to some questions that are popping up. Just for those of you who are on or may have joined later, a copy of this presentation will be emailed to you if you've registered for this. It'll also be archived on our webpage. And I want to just jump right into some of the Q&A that's coming up, because I'm getting a lot of questions here, and I'll just pick them randomly. I think some of these questions may have been answered. What happened to the company symbol? The company symbol remains the same. So when you come off a national exchange and you're a US listed company, you come to OTC, your ticker remains the same. Question number 2, do I need to find a market maker? Joe, you want to answer that one?
Sure. So the answer 9 out of 10 times, Andy, is no. And In fact, a lot of the market makers that trade through OTC are also market makers on NASDAQ and NYSE. And so in many cases, companies retain the same market makers when they're coming off the exchange onto OTC markets.
I have to unmute. Okay. Does anything change for the investor? Can they still trade through their online brokers such as Schwab, Fidelity, TD, or E-Trade?
I'll take that one, Andy. Like I said earlier, we operate very similar to NASDAQ and NYSE. We're regulated by FINRA and the SEC. To that extent, the answer is no. An investor, if they wanted to transact an OTC security, they would execute that trade the same way they do a NASDAQ security. So when you go onto your E-Trade account or Schwab account, nothing changes. I'm sorry, Andy, you're on mute.
A question around, I know sometimes I should be on mute longer. You mentioned delisting and deregistration are two different things, Walter. Can I delist but not deregister, or vice versa? Or is there an order in which it can happen, or can they happen independently?
They can happen independently, or they can happen together. So you can delist without deregistering. So again, to repeat, delisting is just terminating your stock exchange listing. It doesn't involve the U.S. government obligations. However, if you deregister from the SEC, you also would have to be delisted from the stock exchange, because the stock exchanges require registration of the SEC as a condition to being listed on the stock exchange. So again, you can delist without deregistering, but once you deregister, you would also have to be delisted.
Thank you, Walter.
Okay.
I have a question here that's coming up. One of the risks to delisting and going to OTCQB or OTCQX, it's viewed as a negative perception. Example, company is not doing well. What strategies are there to combat this market perception when delisting? Rob, any thoughts around that?
Yeah,
Maybe around
sure.
our strategy
Absolutely.
and positioning? Sure.
Yeah, I think that's exactly the right answer there, Andy. I think at the end of the day, it's all about the branding and the messaging that the company has, and how this occurred, why it occurred, and what are they doing to remedy this. I think it's all about the IR, and when things are negative and there's some dislocation within the company, I think at that interval, it's really more important for the CEO of the company and the management team to be out in front of it, right? To not hide away from it. So, having the right corporate communication and IR strategy around the event and what is being done to do so. Again, particularly if the capital raise that may be needed to get that remedy done. I think the messaging and the IR piece comes into play in a very strong way, Andy.
Joe, any added comment to that?
I mean, sure, Andy. Obviously, I'm a little biased on my end, but if you want to control the narrative of, say, this kind of situation, a positive would be a company being kind of upfront and proactive, saying they're going to move to OTC to kind of save some money, right? Regroup and re-strategize, versus just flipping a switch to a reverse split and kind of pretending nothing ever happened or nothing is wrong, right? So I think, obviously, it takes some work from the board's perspective, but to kind of get ahead of the narrative and demonstrate, why you're doing, say, a move to OTC and what it's going to benefit, how it's going to benefit, I think would be a way to position that in a more positive light.
That's good. Shifting gears. Walter, this is going to come to you. For a TSX, Toronto Stock Exchange listed issuer, does satisfaction of the OTCQX standards equate to current public information for Rule 144 purposes? Okay, I'll repeat that. For a TSX listed issuer, does satisfaction of OTCQX standards equate to current public information for Rule 144A purposes?
Sure, Andy, I can answer that question. And I think the answer there is yes. The reason it's a yes is because this obligation under Rule 144 requires one of two things from the company. Either it continue to be reporting to the SEC, or it provides certain other types of current public information. And as I mentioned earlier, the OTCQX requirements are one of two things. Either you have an ongoing SEC obligation, which means you've delisted from a US stock exchange but not deregistered, or you maybe, in the case of a Canadian company, never were listed on a US stock exchange, but you are registered with the SEC. Or in the alternative, you maintain the so-called Rule 12G32B SEC exemption, which again, to do that is relatively simple. If you're listed on an accepted foreign stock exchange like the TSX, you just simply post on your corporate website in English anything you file in the case of a TSX company on CDAR in Canada. If you're on OTCQX, you would also have to simultaneously submit those through an electronic method, to OTCQX, but it's just duplicating exactly what you would submit up in Canada. So again, the answer is yes.
Thank you. Rob, this one's coming to you. Freedom recently announced its intent to acquire a U.S. investment bank called Maxim Group. We mentioned earlier, but given the economy and lots of microcap companies need funding, if a company decides to forego a reverse split to maintain its NASDAQ listing, is it possible to raise money on QB and QX? You touched on this earlier. For those who aren't aware, before listing on NASDAQ, Freedom was quoted on OTCQB, but could you just repeat a little bit on cap raise and off exchange?
Absolutely, Andy. Look, the answer unequivocally is yes. A company can raise money as an OTC company in many different ways, right? There are private placements that to be done. There could be registration statements that can be filed to do a transaction. So there could be bridge financing that could come into play. So there are multiple ways that a company can be financed. I think the real trick and the answer is with whom they do the transaction and what the targeted investor base is at the end of the day. If you're staying out of the, quote unquote, murky end of the pond here with respect to some of the structured funds, right, or the predatory investors, and maybe targeting family offices or targeting retail investors that are looking for maybe a turnaround story or a true growth story from an emergence perspective. I think that's something that is very doable. And again, I would not be, again, back to Freedom did a reverse merger listed on OTC and frankly did a $10 million private placement at $3, while they were on OTC when we first listed. So, that people that invested in that private placement 6 years ago are sitting with a stock that's worth $83 right now, or $82. So, again, first thing I said, I will repeat again, OTC and the platforms there are not death sentences. They are definitely viable platforms in areas where companies can raise capital, Andy.
Thank you, Rob. I want to shift gears a little bit, go to Joe. Joe, a question has come up about blue sky requirements. What are the blue sky requirements are there when making the move from an exchange to off exchange? Maybe you could touch on that and give some clarity to blue sky.
Sure, Andy. So going back to the three markets we operate, the top two, OTCQX and QB, are SEC recognized markets. With that, they receive automatic blue sky exemption in a number of states. I believe it's 38 states for OTCQX and about 34 states for OTCQB. That number will continue to grow over time, but the answer is yes. Companies on QX and QB receive the same blue sky exemption they do on NASDAQ or NYSE, up to 38 states for QX and 34 states for QB.
And blue sky exemption allows for an advisor to recommend, solicit, or advise those shares to non-accredited investors. Joe, I have another question coming your way. What are the listing fees for OTCQX, OTCQB? Maybe we can all touch on some of that as well.
Sure. Our fees are flat. The QX fee is roughly $25,000. The QB fee is roughly $15,000. Both require an application fee of $5,000. But I think the key takeaway is that they're flat fees. So with our market, we do not charge for listing of additional shares or for an opening bell ceremony, or for reverse splits or corporate actions, our fees are pretty much flat.
Andy, may I just jump in here for one quick second? I know you did mention the maximum transaction in the
Oh,
last
yes.
question. I just want to clarify just two things here. A, yes, we do have a public deal that was announced in February for our parent company, Freedom Holding Corp., to purchase 100% of Maxim Group. Just want to be clear that it is still within FINRA process. So the transaction has not closed. We are, probably hopefully midway through the process and move towards a closing. And from a Freedom perspective and from our perspective, obviously we are extremely excited about this potential combination and what it potentially means for us and potentially for the small micro cap community moving forward in a combined entity. But I would have felt remiss if I didn't actually address the Maxim situation, since you did mention it in the question. So thank you, Andy.
I think, this is bringing us to the end of our webinar. I think that, do either of you have any comments or closing comments that we haven't touched upon that you want to just add and close out with? Because I think we've covered capital raise, we've covered delisting, deregistration, we talked about splits, convertible financing, process, timing. Any closing comments while we have about a minute or two left that you want to just touch upon?
I did quickly, Andy, you want to go back to Walter just for 1 second. We had a slide up here talking about the US requirements for QB and QX, one being the auditor requirement, PCAOB. There is a big selling point, to deregistering if you're a foreign company. Walter, could you talk through the auditor requirement or lack of requirement for a foreign company looking to deregister?
Sorry, let me take you off mute. So if you're a foreign company that qualifies as a foreign private issuer, and as one of my earlier slides mentioned, you have a primary trading market overseas, you're in good standing with the SEC and all those types of things, and you have less than 5% of your trading volume in the United States, you're eligible to terminate your SEC registration, not just simply delist from a stock exchange, but you can terminate your governmental obligation to the SEC, which can have quite a few cost savings. You obviously don't need to make your ongoing SEC filings, but as part of that, you no longer need to worry about Sarbanes-Oxley compliance. You don't have to have an attestation as your internal controls. You don't necessarily have to have a PCAOB approved auditor if your home country does not require that. You don't need to use US GAAP financial statements, for example. So there's quite a number of cost savings you can realize by no longer having to have an SEC reporting obligation. And so long as you're listed and in good standing in one of the qualified foreign stock exchanges, which again, there's a long list of them on the OTC website, but most of the recognized and reputable foreign stock exchanges are on that list. You can maintain your OTC listing here as a foreign company. You can provide, from what I can tell, and obviously Rob and Joe can speak to this more, every bit as good and as liquid of a trading market to your US investors as you could have in one of the regular stock exchanges. And you can save a great deal of compliance costs in the process.
Great, thanks,
Thank
Walter.
you. Thanks, Walter. Rob, any closing? Are you good?
No, I think I'm great, Andy. Thank you for this. You did a fantastic job making sure that we, covered all the salient topics that we kind of set out to do so. So again, thank you from the Freedom side for including us and allowing us to participate with you today.
Thank you, Walter Walter Van Doren from Dentons. Thank you, Rob Botzek from Freedom Capital. Thanks, Joe from OTC Markets. A copy of this presentation will be mailed to you. An archived recording will be available on the OTC Markets website, and those who registered will get a link. Any questions we didn't get to answer, we will email you with answers, and feel free to contact us. Our contact details are on the last page of the presentation that's on the screen. So again, from OTC Markets, we thank you for joining the Thought Leadership Series, and thank you to all our guests.
Thank you.